you see that supply pretty much followed demand along the lines here. Now, we reached 2006 when oil prices actually started reached already $50 a barrel, which should be more than enough incentive to provide more than enough incentive for producers actually to invest in projects and start pumping more oil out of the ground, even if those new fields are not, but it provides incentive for development. And especially as oil prices reached $140 in 2008, that's even further incentive for supply to increase. And you see very clearly through the charts that we reached a plateau in terms of supply. Supply is been struggling to follow the pace of demand. Now, this points to a clear constraint in the global production at this point in time. But the question is, what actually is the impact? What does that, why is that so important for us at this point? Now, you're probably going to remember, a very interesting decade, which is the 70s. And I would say that the next decade, it's the 70s all over again. But this time, it's due to scarcity, not just geopolitics. If you remember the 70s, there was an oil supply crunch due to the OPEC embargo on oil production, and that caused obviously a major issue in the economy as most countries were very dependent on oil, and prices skyrocketed from the beginning of the decade towards the end of it. Now, throughout that decade, we saw something which it was kind of a conundrum for economists up to that point, something called stagflation. Basically a decade of a very low economic growth or even economic slowdown with high inflation. And why does that happen really? Why did we have a stagflation? And that goes back to this statement from the IMF presentation previously. Oil is key factor for our production chain. So oil is used in everything. So the price of oil go up very significantly. Pretty much all products and everything we consume and we do that as well. So that is inflation, prices going up. While at the same time, as businesses see higher uncertainty, costs are going up significantly, they start either dropping new expansion projects, shutting down operations, even costs are higher. And that is the effect that inflation has, or that stagflation had in the economy, or oil price had in the economy. Pretty much higher prices with a slowdown in the economy, which is counterintuitive from classic economic theory. Now, this inflation process has been already triggered as we went through the crisis of 2008-2009 due to excess liquidity in the economy. Even before oil prices reached the level that we have now, remember 2009, oil prices reached the bottom value of $35 to $40 a barrel. We are now in excess of $100. So even before that, inflation was already triggered, especially as the Fed quadrupled its balance sheet in order to provide liquidity and stimulate the economy to get out of a prospective depression. Everything we have now a lot more monetary units chasing the same or even lower amount of goods and services across the world, and that's not only US dollars. That happened through in UK and Europe as a whole as well. Basically, this what the effect that has is that you trigger inflationary process with higher stock responding to that, with higher earnings from companies and everything. But then that promotes further growth in the economy. That also pushes up demand. And now we reach a point in which oil prices are going higher, specifically because we have a scarce amount given the level of demand that we observe. Now, just moving to the next slide. So, what can we do about it? at this point. What is really the alternative for us to handle this, given we have a very hard decade ahead? Now, for businesses, the best thing that business can do at this point is to hedge the exposure to commodity prices through futures, forwards, and options. The financial system is well equipped at this point in time to provide these hedges. Now, I saw recently in Bloomberg TV, as companies are reporting earnings at this point, just one small example, like PepsiCo just reported higher earnings, and they attributed that due to the hedging strategy that they executed through their commodities, the commodities exposed to their production chain. It's available for pretty much every company to do it. I notice as I approach companies and are actually trying to sell hedges to companies, it's not something very usual that companies sometimes tend, or CFOs sometimes tend to take a view in the future and gamble. And as if the operations of their own business were not enough already in terms of risks, they actually take a gamble on prices of products that are not even within their core business. This advice for business at this point is really to hedge against commodity prices, which, as pointed out also through the IMF presentations, I expect it to continue going up. Regarding the upper and middle class, who are usually investors? They have excess income, they invest, they save the money, they invest in bonds, in savings accounts, and so on. Now, for them, the best way forward is to demand inflation hedge from their bankers. Now, just to give you a very good sense of it, I have living memory of high inflation, what high inflation can cause. Now, I'm from Brazil. I lived in Brazil through the early 90s when we had 30 to 40% a month inflation. And it's a very distressing situation, not only for the upper classes, but also for the lower classes. Now, you get your salary in 1 month, you rush to the supermarket to buy everything before it goes up. I'm not really claiming that we're going to reach 30 to 40% a month inflation, but a good 10 to 12% a year is very likely. And about 6 to 8 years of that is already enough to reduce the purchase power by half